Welcome everyone to another episode of Mere Finance. Today we're going to talk about loans. It's an unregulated market, and it seems to be a market that is never in the news, but it is in a similar size as bonds. And as we think about loans, they are unregulated to the investor, but also they create a big opportunity because a lot of the companies that cannot get into the bond market, they issue loans, so you have a pretty diversified market industry-wise. So let's start. So the objectives for today is analyze loans from the yield, but a specific one, which is the payback yield. So why is it payback yield the proper yield to evaluate loans, and what is the calculation for your review? So as we said, loans are not considered securities like bonds, and they are not regulated by the SEC, and usually are in the high yield space. So think about in ratings from the single C's to the triple or to the double B's. Now, yield to maturity is usually the one that we use for bonds or for any other fixed income security, which basically tells you the total return anticipated on a bond if it held until it matures. So you bought a bond A today, it matures in 1 year, and it pays certain interest. So you want to see, all right, how much interest is going to give me, plus the principal that I lend. So it takes into account the time value of money, because your interest is re-evaluated based on the money. Of course, the first coupon or the first interest that you get won't be valued the same way as the last one, because there is a difference in time. And as we say, time makes a lot of difference in money. Money now is worth more than money in the future. Loans are not a fixed income security in the sense that they are not traded like a bond, and they represent mostly a venture or a business, because you are lending them money without expecting the principal back. You're just expecting the coupon, basically. So loan, it focuses on the time, the payback yield for loans, it focuses on the time it takes to recover the initial investment through the project, in this case, the company, the issuer, or the issue project's cash flow. So think about it. It's the insight into the speed at which the invested capital is recovered. If you lend issuer A certain amount, say $100, you need to calculate the periodic interest. Say it is, $5. So basically it will take you 20 payments to just break even. So then until it matures, you want to see how much money you got, and then calculate that yield, but without taking into account the principal payment. So we're going to see it more in the calculation. So payback yield is the coupon plus the difference between the notional amount issued on the security minus the security price times the percentage in time, which is calculated by 365, which 1 year, divided into days to maturity. How do you calculate the coupon? So the coupon, usually loans are floating rate securities. This means that they are tagged to an index, and then based on the security risk of the security issuer, you calculate a spread. Think about when you have a mortgage. If you have a variable rate, it basically says, all right, we're going to use the SOFR curve. What's the level today? And we're going to generate a spread. The higher the spread, the riskier the asset, because the investor requires a higher return. So if the index is a certain amount, add the spread, and that will be your coupon. So we go into the formula itself. Basically, as we said, let's see SOFR, which is usually around 5.38 now, and you have a spread of 3, your coupon will be 8.38. Now, this depends on the coupon frequency. So if it's a quarterly paying security, it will restart every quarter. So every quarter or every 3 months, you will look at the SOFR rate, and then you will add the spread. So the SOFR rate can vary, the spread won't. And then when you see, The notional is usually default to 100 because that's like par. That's what usually securities are issued in. And then your days to maturity. If it's 10 years, it will be 3,652 days, taking into account the leap year. So in our example here, to evaluate payback yield, then we have to have coupon first. So in this case, let's say it's 8.38. And the price is trading at 108 cents. It's almost 2,451 days to maturity, which will be close to 6.7 years. And then your notional is 100. So this will give you a payback yield of 8.36%, which is lower than your coupon because the price is higher. So in theory, this security will give you, once it's paid back, a yield of 8.368. Once it's paid back, that's the difference, not a yield to maturity, not until it matures, once it is paid back. So there's a difference. It's important. You also have paid back yield to 3 years. So basically, your days to maturity wouldn't be 2,451. It will be 365 times 3. So basically, it would be a static number in your days to maturity. You can have payback yield to maturity to 3 years, 5 years, 7 years. So I hope this has been informative. And you take a look into loans, or when you lend someone money, the payback yield. Now, your coupon might, if you lend a friend money, then your coupon most likely will be fixed because usually don't change. And the price of the security will be probably 100. So the only thing that will change, in theory, will be the days to maturity. So until the day that person pays you back. So thank you for watching, and don't forget to subscribe to Mere Finance.